I'm Evan Polaski, Managing Director of Investor Relations with Ashcroft Capital. Today, I'm back with Scott Lebenhart, our Chief Investment Officer. Scott, why don't you give us a quick intro of yourself for our new viewers?
Great. Hey, Evan. Yeah, Scott Lebenhart. I'm the Chief Investment Officer here at Ashcroft. I've been working at Ashcroft since 2018. Prior to that, I was at a private equity company called DRA Advisors for over 11 years. And here at Ashcroft, bought over 14,000 units, over $2 billion worth of assets here. And as Evan knows, and the return viewers know, Evan and I like to get on a quarterly basis and talk through what we're seeing in the market.
Yeah, appreciate that. And let's jump right in. So looking back to Q2, kind of how's the market continued to evolve since it hit the brakes towards the end of 2022?
Yeah, I mean, in my opinion, and based on what I've been seeing, Q2 is fairly similar to Q1. It's been really slow, especially on the transaction front. Continued uncertainty around the Fed and what they're going to do with interest rates has really kind of halted everything right now. It's really halted lenders, the buyers willing to execute, and sellers necessarily not knowing what quote unquote market pricing is. In Q2, the CPI measurements, the unemployment numbers, employment indicators, and other economic indicators sent a lot of mixed signals. And so people couldn't guess and say, hey, what's the Fed going to do next? When are they going to start to pause their increases? When are they going to stabilize? When are they going to start to come down? And with interest rates remaining high and no real insight as to when those rates are going to start to come down, it's just continued to be a stalemate through the second quarter. We saw the minimal amount of deals that went under contract or were awarded. We did see a handful of those actually fall out of contract and come back to market, or the seller decided to hold, just given all the volatility on the capital market side. So it was good to see some deals at the end of Q1 get under contract and get awarded. But in this market, we continued to track those deals, and unfortunately, some of them did not go through. So Q2 was a lot of the same at the beginning of the year, and just not a lot.
Yeah, and we're seeing that obviously in our transaction volume. But speaking specifically to Ashcroft, how many deals did we see come across our desk that we ultimately underwrote? And then of those, how many LOIs did we submit?
Yeah, I mean, so I look back at our numbers. We looked at about 125 deals that came across our desk, but in terms of what we actually underwrote, that number was closer to 60 deals. So 50% or so of the deals that came across us, we actually spent time putting pen to paper on. Two reasons for that percentage, where it's typically much higher, that we're looking at spending time on a lot more. But two reasons is, one, we're being highly selective. If it's not in the market or the submarket that we want to be in, if it's not the quality of the asset that we're looking for right now, no need to spend our time on it. And then secondly, if a purchase is the price on the property is unreasonable, and we know that the seller really has no driving motivation to sell, we're interested in spending time on deals that the seller is more likely to transact than not. So, you get a pie in the sky price on some deals, and you just kind of push it aside and say, hey, I'll wait till the seller gets a little more realistic on it to look at.
Yeah, a deal that's worth buying, but we just know, from all of our experience that their whisper price or official asking price is just too far off to even waste time plugging numbers into a spreadsheet.
Exactly.
And then how did we actually submit any LOIs of those 60 that we were underwriting?
Yeah, so we submitted LOIs on around 12 deals over the past quarter. And a lot of those deals were more on the off-market transactions. We spent a lot of time trying to drum up deals off-market in nature. But some of those LOIs were sent more discovery on, hey, seller, here's our price. And then getting the feedback and seller saying, oh, no, I'm looking for 20% higher than that or something on it. But we still wanted to show that we are active, we are looking for deals. We did get that two fantastic deals under contract, through the relationships that we have in the market. But it's been really tough to mitigate that bid ask spread that's out there right now.
Yeah, and just as a reminder for one of those teal deals that you just mentioned, by the time this actually comes out and our viewers are watching this, we will likely have closed it. So one closed and in August, and then the others coming towards the tail end of August as well. So I appreciate that. It sounds like you said, kind of more of the same as it sort of felt
Mm-hmm.
broadly in the economy as well. But now as we're fast forwarding next 3 months, 6 months, probably even to Q1 of 24, where do you see that market heading since we've been kind of flat? Is it continuing to tighten? Is it going to start loosening? What are your thoughts?
So I am starting to be a little more optimistic. And part of that is based on the debt market. I'm starting to see signs of us, beginning to come out of this period of the cycle where virtually nothing gets done. We're seeing lenders starting to become more aggressive. And we're also seeing more money pursuing making loans. With interest rates so high, we're seeing um, groups looking to issue debt as opposed to invest in equity into deals. Based on where the treasuries and interest rates are right now, some of these mega billion-dollar, funds are saying, hey, I could get my risk adjusted return by issuing debt at 7, 8% as opposed to go buying, actually owning the real estate of the deal. And so we've been seeing a large amount of groups kind of create funds targeting debt, create preferred equity positions as part of it. And I view this as part of a good part of the cycle as money starts to funnel back into the space. And as we see more lenders come into the market and create this liquidity, I believe we're going to start to see spreads coming down. Competition always, is good for the market. Our capitalistic society, people want to win deals and start to be willing to pay more, or in a lender's case, reduce their spread on it. And I do believe that this will help to narrow some of that gap that we were talking about in Q1 and Q2 between the bid-ask spread between buyers and sellers. So don't get me wrong, I'm not saying that it's going to be like a flip of the switch and happen overnight. But this is the first sign where we're out looking for refinances, new acquisition financing, and we're seeing a lot more lenders come to the table, and a handful of them willing to be a lot more aggressive in order to get the deal done. So we're starting to see a break, which I'm excited about.
Yeah, and as we've discussed in the past, when the lenders have to price in their own risk, so they're
Mm-hmm.
kind of inflate. I won't say inflating, but they're adjusting their rates to account for their own risk, and then we would have to do the same on our risk. That's
Mm-hmm.
where the big bid ask spread is coming, because we're kind of hitting it on both sides. So as a
Right.
big chunk of that with the lender starts to narrow their risk or their thoughts on risk, and there's more demand out there, then clearly that starts to ease up one side of the equation on the pricing that we're ultimately looking at. So appreciate that. And I know in the past, as we're hopefully starting to see a slight relaxation in the market coming down the road, how's your team evolving? I know we focus a lot on specific assets, a lot of outreach. Does that remain the same? Is it continuing to shift?
Yeah, it continues to modify slightly based on what we're seeing in the market. As I mentioned about Q2, the majority of deals that we spent, the most time on were the off-market deals. We've now transitioned to where we monitor the market deals. It's a good indication, if those deals do actually trade, where people are willing to pay, where people are willing to sell. So it's something we are always going to pay attention to. If the right deal comes along and we have the right relationship with the seller and it's in the right market, absolutely we will pursue those. But we view most of the opportunities right now through an off-market approach. We're doing a tremendous amount of research on potential opportunities. We're trying to find the right deals, meaning we're looking at very specific submarkets, specific vintages, specific demand drivers, specific average household incomes, and really taking a targeted approach. We basically, not to give away our secret sauce, but we are having a very targeted research on deals that we believe sellers would be willing to transact on, whether they bought them 5 years ago, pre-pandemic. We believe, based on our research, that they have debt coming due within the next year or two. or perhaps even shorter term, or it's invested in a fund that's likely going to be, into its liquidation mode shortly. So we're doing a good amount of research behind the assets themselves. We're finding the assets first, and we're finding reasons why someone may be looking to sell in the near term, and that's how we're really targeting our deals. And given that, we all know, and I speak about this all the time, how real estate is a relationship business, we're really utilizing our relationships with that in order to gain knowledge about properties that may be coming to market soon or being willing to sell soon, and working to drum up deals that way. So we are heavily researching and trying to find a diamond in the rough right now.
Okay. Yeah, and that's sounds like it might be the only way, because as you noted, you saw 125 deals come across your desk. I know some of those are on market, some of those are off market. I'm sure back in 21, and I know I didn't ask you to pull these numbers. You probably saw that in a month of just on market
Yeah,
deals.
could have been a week or something.
Yeah.
Some weeks were crazy.
Yeah, so you got to find them somehow.
Yep.
But kind of the big topic that I've been hearing lately in my conversations, my team's conversations, is what's happening with this, this mortgage doom that's coming as all these short-term loans that were taken out in 20 and 21 start to come due. Do you foresee there to be a lot of distressed deals coming down the pike in the near future?
So I'll admit, earlier in the year, and you probably have me on record saying it, so I'll admit it. I was not expecting much distress to hit the market as much as everyone was expecting, because I believe, when we were doing this conversation, that we'd be talking about interest rates starting to come down at that point, and help to alleviate some of the pressures on certain deals with debt maturities, or rate cap issues, or just a light at the end of the tunnel for some of these. That has not happened, and so I will be the first to admit that I do believe that I was wrong, and that there is more distress coming than I originally thought. That being said, I do not expect a flood of distress to hit the market all at once. I think these are deals that are going to trickle out over time, and I believe they're also going to be extremely relationship driven in terms of who gets what deal. I think lenders as a whole are generally not interested in taking deals back and being owners of deals and then therefore having to sell them. I think they're, even based on our direct conversations with certain lenders, they're going to be willing to work with good borrowers. And by good borrowers, I mean those that are working to execute the business plan. Perhaps they're unable to buy an interest rate cap that's required because of liquidity issues or something like that, where the asset itself is doing fine, but because of the capital markets, there's some level of distress with it. If lenders do ultimately take deals back and foreclose on a deal or force a sale, at that point the lender is going to be driving that sale and selecting the buyer on it. I think they're going to be, because we saw this back in 2009, 2010, as lenders were trying to get rid of some of their loans that they had on their books. They would sell to groups that they worked with, groups that are kind of institutional in nature, have strong balance sheets, that they have a high certainty to close. They're not looking to lend this to the highest bidder out there. They're looking to purely look to someone who's going to ultimately transact on it, and perhaps even structure a deal where that lender will stay in the deal with the new borrower and try to find a way to recoup some of their losses if there were any. And we've also discussed, the amount of money moving onto the debt side. There's a lot of preferred lenders out there looking to help bridge the gap on some of these deals. There's groups raising money purely for rescue capital on these deals. And so there will be deals that are distressed and do get forced to market and lenders do foreclose on. But again, I think we've already seen it in the market with some of these larger institutions that are well capitalized. They've gone ahead and said, hey, my floating rates are extraordinary right now. I got, millions of dollars of rate cap purchases. We've seen them go and refinance with the agencies. They would go and take 20, 30, $50 million on a portfolio and pay down the debt in equity in order to just readjust their capital stack to market, conditions. So again, there's going to be the outliers where there is distress coming to the market, but as a whole, I'm really not seeing the flood. But what we're doing is we're not waiting around for the deals to be distressed to hit the market and come to the market. Through our research, like we just discussed, we're targeting deals that may perhaps be in a distressed situation as opposed to ultimately being a distressed deal. And what we're doing is having conversations with those owners and trying to come up with a creative solution for them where, maybe we step in and buy part of the deal, fresh equity into the deal, take over the management, take over the control of the deal, and leave that owner in for some type of upside if we're able to wait this out. But everyone's kind of in the sense right now where fundamentals in multifamily are still relatively strong. This is a capital, the distress is caused by the capital markets in the majority of situations, not at the performance of the properties. And so owner's first instinct is going to be find a way to kick the can down the road. And I tend to think that that's going to be more predominant in the market than a tremendous amount of distressed deals.
Yeah, no, and I think that aligns with things that I've seen personally. As you said, there's rescue capital, there's a lot of capital waiting in the wings. And, even thinking back to my experience in 2009, it's what deals got reworked. Well, they were ones where there was actually an opportunity to see a light at the end of the tunnel versus a bad operator with the bad deal, where it's just like, we just need to take this and get it off our books as fast as possible. So with that, I personally align with you, but I appreciate those insights.
Yeah. And I'd also say, thankfully we're hopefully everyone listening is in the multifamily space or industrial space but from our conversations with the lenders, their main concern are the office assets right now. Those are the ones where unfortunately they are going to have to take back, where there will be foreclosures on it, lender controlled deals. They do not want to take multifamily assets back right now. They view them as cash flowing assets that perform well, that are distressed because of the capital market. So every time we bring up multifamily to an investor as a potential issue, they said, we're not worried about multifamily right now. We're focused about our office loans.
Yeah, it's everybody needs a place to live. So
Yep.
just core level of the business plan, it's pretty well insulated in that regard. Well, with that, I really appreciate all your time, Scott. As always, great to hear your insights this quarter, and certainly look forward to doing this again next quarter.
Yeah. Hopefully, we'll be talking about more deals next time.
As long as they're the right deals, but yes.
Exactly.
Well, I appreciate all you do for us and appreciate your time. Thanks so much.
Thanks, Evan.